If you've been watching the precious metals market over the past few weeks, you just witnessed something that separates investors who truly understand market cycles from those who let emotion drive every decision. Silver just exploded over 9% in a single trading session. Gold surged more than 4%. And this happened right after one of the most brutal sell-offs we've seen in years. I'm talking about a metal that dropped 32% and erased trillions in value, only to come roaring back with the kind of move that leaves most people scratching their heads wondering what just happened. Right now, spot silver is pushing above $80 per ounce. Gold is climbing back toward the $4,800 mark. And if you weren't paying close attention, you might have completely missed the reversal that could define the next phase of this market. Before we go any further, if you're getting value from what we share here at Element Axis, go ahead and hit that subscribe button. When markets move this violently, timing is everything. The difference between seeing the next update in time or missing the move entirely often comes down to whether you're subscribed. Also, drop a comment below and let me know if you're holding precious metals right now or if you're watching from the sidelines. I read every single comment, and your perspective helps shape what we cover next. Now let's talk about what actually happened here, because the mainstream explanation barely scratches the surface. The simple story is that gold and silver sold off hard, then they bounced. That's it. Market correction followed by recovery. But that narrative completely misses the most important parts. It misses why the sell-off happened in the first place. It misses the forces behind the bounce. And most critically, it misses what this price action is telling us about where we're headed next. Here's the framework you need to understand. Markets never move in straight lines, they move in cycles. And these cycles, whether by design or just basic human psychology, are structured to inflict maximum pain on the maximum number of participants. People who bought at the peak feel pain when prices crash. People who sold during the crash feel pain when prices bounce back. The only people who avoid the pain are those who understood the cycle from the start and positioned themselves accordingly. Let me walk you through exactly what happened step by step. The trigger for this recent sell-off was the nomination of Kevin Warsh as chairman of the Federal Reserve. Now, if you don't follow central banking closely, Warsh is a former Fed governor with a reputation as a hawk. Markets interpreted his nomination as a signal that monetary policy might be less accommodating going forward. When that news hit, traders immediately started repricing their expectations for future interest rates. Here's what you need to understand about gold and silver. These metals are extremely sensitive to interest rate expectations. When traders believe rates are going higher or staying elevated for longer periods, they tend to sell precious metals. The logic is simple. Gold and silver don't pay interest or dividends. They just sit there. So in a high-rate environment, the opportunity cost of holding these metals feels greater. You could be earning yield elsewhere. But here's the detail that most people miss entirely. The initial market reaction to news is often completely wrong. Markets overshoot in both directions. Traders panic. Algorithms trigger cascading sell orders. And by the time everything settles down, prices have usually moved far beyond what the actual news justified. That's precisely what we saw here. The sell-off was absolutely violent. It was fast and merciless. Silver dropped over 30% from its recent highs. Gold fell to its lowest level in nearly a month. The move flushed out an enormous amount of leveraged long positions. People who were betting on higher prices with borrowed money got wiped out. But then something very interesting happened. The bounce came hard and fast. Silver didn't just recover a little bit. It surged 9% in a single session. Gold jumped over 4%. And this wasn't some slow grinding recovery where prices inch higher over days or weeks. This was aggressive buying that came in with force and conviction. Now let me ask you something, and I want you to really think about this. Who has the kind of firepower to push silver up 9% in a single day? It's not retail traders. It's not small hedge funds making modest bets. That kind of move requires serious capital. That kind of move tells us that big players, the real money, were stepping in to buy what weaker hands were forced to sell during the crash. And if the crash was designed to shake out those weak hands, and if smart money stepped in to buy the dip, then the people who sold at the bottom just handed their positions to the people who understand exactly how this game works. Market analysts have been commenting on this price action, with some suggesting that current prices are close to fair value given the irrational behavior we've seen over the past several weeks. That's an interesting choice of words, calling the recent price action irrational, suggesting that the extremes we saw both on the way up and on the way down were driven by emotion and speculation rather than fundamentals. If that's accurate, then maybe current prices represent something like equilibrium. But here's my question. What does fair value even mean in a world where central banks are printing unprecedented amounts of money, where debt levels have reached historic highs, and where the entire financial system depends on continued confidence in paper promises? Fair value for gold is not some fixed number you can plug into a spreadsheet and calculate with precision. Fair value for gold is whatever level reflects the market's trust in the monetary system itself. And when that trust starts shaking, fair value can move very quickly in one direction. So when an analyst says we're at fair value, what I hear is that we're at a level where the market is temporarily balanced. But temporary balance doesn't mean permanent stability. It just means the next catalyst will determine whether we move higher or lower from this point. Let me give you some context on just how explosive these recent moves have been. Gold jumped 13% in January alone. That's the biggest monthly gain since November 2009. Think about that for a second. We just witnessed the strongest January for gold in over 16 years. And silver performed even better. Silver surged 19% in January, outpacing gold by a significant margin. These are not normal returns. These are not the kind of moves you see in quiet, stable markets. These are the kind of moves you see when something fundamental is shifting beneath the surface. And here's what I think is shifting. Confidence. Confidence in the dollar, confidence in monetary policy, confidence in the ability of governments to manage their debt loads without eventually resorting to inflation as the path of least resistance. When that confidence starts to crack, money flows into hard assets. And gold and silver are the hard assets that have survived every single monetary crisis in human history. If you're finding this breakdown helpful, hit that like button. It actually helps more people find this content when markets are moving this fast. And stick with me because we're about to get into the ETF numbers that really tell the story of what retail investors have been doing. Let's talk about what's happening in the exchange-traded fund market, because this is where you can see retail sentiment playing out in real time. Silver ETFs absolutely exploded during the recent rally. Some silver ETFs gained over 9% in a single day. Across the board, silver ETFs posted gains that significantly outpaced their gold counterparts. But here's the number that should really capture your attention. 1-year returns on silver ETFs are running between 250% and 278%. Let that sink in for a moment. If you had put money into a silver ETF 12 months ago, you would have more than tripled your investment. Gold ETFs posted strong returns as well, but they were more measured. Daily gains in gold ETFs ranged from about 4% to 5%, and 1-year returns were approaching 100%, effectively doubling investor capital. Now here's the pattern I want you to see clearly. Silver moves faster than gold. It always has. When precious metals are rising, silver tends to outperform gold by a factor of 1.5 to 2 times. When precious metals are falling, silver tends to fall harder than gold by a similar ratio. Traders call this higher beta. Silver is more volatile, it's more emotional, it's more driven by speculation and momentum. And this creates both opportunity and risk. If you're right about the direction, silver will amplify your gains substantially. If you're wrong about the direction, it will amplify your losses just as much. That's the trade-off you accept when you choose silver over gold. Now let me address something important because I want to give you balanced perspective, not just hype. Some analysts have issued caution about silver right now. They're saying it's too early to build long-term exposure to silver, citing ongoing price fluctuations and heightened volatility. They're essentially warning that silver is too hot right now, too unpredictable, too risky for investors who want steady and reliable returns. And honestly, they have a valid point. Look at what we've witnessed in just the past few weeks. Silver ran up to over $120 per ounce, then it crashed 32% in a single session, then it bounced 9% in a single session. That kind of volatility is absolutely not for the faint of heart. If you're someone who checks your portfolio every single day and feels physically ill when you see red numbers, silver might not be the right asset for you right now. But here's the other side of that caution. The biggest gains in any market come from the assets that are the most volatile. You don't double or triple your money by buying stable, boring investments that barely move. You do it by buying assets that have the potential for explosive moves and then having the stomach to hold through the volatility. So when analysts say it's too early to build long-term exposure, what I hear is an acknowledgement that silver is moving too fast for them to recommend with confidence to their typical clients. But that doesn't automatically mean silver is a bad investment. It means it's a high-risk, high-reward investment that requires a specific kind of investor with a specific kind of temperament. Now, let me add a layer to this analysis that I think is critical and often completely overlooked. Silver isn't just a precious metal, it's also an industrial metal. Gold sits in vaults, gold sits in jewelry, gold gets held by central banks as a reserve asset, but silver gets used, it gets consumed, it gets embedded in products and often never comes back to the market. Silver is critical for electronics, it's critical for medical equipment, it's essential for water purification systems. And perhaps most importantly right now, silver is absolutely essential for solar technology. Every single solar panel requires silver as the world continues pushing toward renewable energy and electrification. The industrial demand for silver is growing, not shrinking. This creates a fascinating dynamic. Silver has 2 distinct sources of demand that can move independently of each other. Investment demand, which is driven by fear, inflation concerns, and monetary policy, and industrial demand, which is driven by economic growth, technological adoption, and infrastructure spending. When both sources of demand are rising simultaneously, silver can experience the kind of explosive moves we've been witnessing. But when they diverge, when investment demand is high but industrial demand is weak, or vice versa, you can get choppy and confusing price action. Right now, I would argue that both sources of demand are supportive. Investment demand is clearly strong, as evidenced by the massive ETF inflows and the wild price swings we've been seeing. Industrial demand is also growing, driven by the global push for electrification and renewable energy. That's a bullish combination. But here's the risk you need to understand. If the global economy slows significantly, if we get a real recession that crushes industrial activity, silver's industrial demand could fall even as investment demand rises. That would create conflicting forces on the price and could lead to more of this violent volatility. So when you think about silver, you need to think about both stories simultaneously. The monetary story, which is about inflation, debt, and trust in paper money, and the industrial story, which is about economic growth and technological change. Both stories matter. Both stories affect the price. Now I want to talk about gold specifically, because I don't want the focus on silver to overshadow what's happening with the anchor of the precious metals complex. Gold is doing exactly what gold is supposed to do. It's serving as a store of value during uncertain times. It's responding to monetary concerns. And it's holding up remarkably well, despite all the volatility in the broader market. The fact that gold jumped 4% in a single session tells you something important. When the selling pressure lifted, buyers immediately stepped in. There was demand waiting in the wings. The dip got bought and prices recovered quickly. This is the behavior you see in a bull market. In a bear market, dips don't get bought. They get sold into. Prices grind lower over time with each bounce weaker than the last. That's not what we're seeing in gold right now. We're seeing strong dip buying, quick recoveries, and a general upward trajectory that's punctuated by sharp corrections. And remember, gold is up nearly 100% over the past year. That's an extraordinary return for an asset that's supposed to be safe and boring. When gold doubles in a year, it's telling you that something significant is happening in the monetary landscape. Central banks are buying gold aggressively. They've been accumulating for years now, and the pace of accumulation has actually accelerated recently. Why would central banks, who control the money supply and can literally print as much currency as they want, be buying an ancient metal that pays no interest? The answer is actually quite simple. They're hedging. They're diversifying away from paper assets. They're preparing for a world where trust in fiat currencies might erode further than it already has. And if the people who actually run the monetary system are buying gold, maybe that's a signal worth paying very close attention to. Share this with anyone you know who's been asking about precious metals lately. They need to understand what's actually happening in these markets right now. Let me give you a practical framework for thinking about all of this. If you're trying to decide between gold and silver, here's how I would approach it. Gold is the anchor. Gold is the steady hand. Gold is what you hold when you want stability and long-term preservation of wealth. Gold moves with dignity. It doesn't spike 30% in a month and then crash 30% in a day. It grinds higher over time with occasional corrections that get bought. Silver is the accelerant. Silver is what you hold when you want exposure to the precious metals thesis, but you're willing to accept higher volatility in exchange for higher potential returns. Silver can triple in a year. It can also give back half of those gains in a week. That's the trade-off you're making. Most people who are serious about precious metals hold both. They hold gold as the core position, the foundation, the thing they never really worry about. And they hold silver as the opportunistic position, the thing that can add explosive returns if the cycle plays out the way they expect it to. The ratio between the two depends entirely on your risk tolerance, your time horizon, and your conviction in the overall thesis. Someone who is very conservative might hold 80% gold and 20% silver. Someone who is more aggressive might flip that ratio completely. There's no universally right answer. There's only the answer that fits your specific situation and temperament. Now, let me talk about something that I think is really important, and this is where I want to add some perspective you might not hear elsewhere. The volatility we're seeing in precious metals right now is not a bug in the system. It's a feature. It is a feature of a market that is trying to reprice in real time as new information comes in and as old assumptions get challenged and potentially discarded. Think about what the market is trying to figure out right now. It's trying to figure out where interest rates are actually going. It's trying to figure out whether inflation is really under control or whether it was going to come roaring back. It's trying to figure out whether central banks can manage their massive debt loads without eventually having to monetize them through inflation. It's trying to figure out whether the global financial system can handle the stress that's building up across multiple fronts. Those are enormous questions. Those are questions that don't have easy or obvious answers. And as the market grapples with those questions, prices swing wildly as sentiment shifts from optimism to pessimism and back again. So when you see silver crash 30% and then bounce 9%, you're not seeing random noise or irrational behavior. You're seeing the market working through genuine uncertainty. You're seeing traders and investors collectively trying to figure out what these metals are actually worth in a world that's changing faster than most people realize. And here's what you need to understand. The volatility isn't going to stop anytime soon. As long as there's this level of uncertainty about inflation, interest rates, and monetary policy, precious metals are going to keep swinging violently. That's not a reason to avoid them entirely. That's a reason to position carefully and to have a clear plan for navigating the swings. Now, I want to address the people who are feeling regret right now. Maybe you sold during the crash. Maybe you got scared when you saw that 32% drop and decided to cut your losses and get out. And now you're watching silver bounce 9% and you're feeling absolutely sick about it. I completely understand. That's an extremely painful position to be in. But here's what I want you to understand clearly. One trade doesn't define your entire investing career. One mistake doesn't mean you can't learn from it and do better the next time. The lesson from this experience isn't that you should never sell. Sometimes selling is absolutely the right move. The lesson is that you should never sell in a panic. You should never make major financial decisions when your heart is racing and your stomach is in knots. Those are the moments when you're most likely to do exactly the wrong thing. The people who sold at the bottom of this crash weren't thinking clearly. They were reacting emotionally. They were seeing red numbers and feeling fear and acting on that fear. And that's human. That's completely normal. But it's also extremely expensive. So the next time you feel that urge to make a big move in your portfolio, I want you to stop, take a breath, wait until the emotion passes, and then ask yourself whether you're making a decision based on logic and strategy or whether you're just reacting to fear. That simple pause can save you from very costly mistakes. Now, let me shift gears and talk about what to watch going forward, because this story is far from over. First, watch the follow through on this bounce. A single day of gains doesn't make a new trend. What matters is whether prices can hold these levels and continue higher, or whether they roll over again and continue the volatility. If silver can stay above $80 and push toward $90, that would be a strong signal that the worst of the selling pressure is over. If it fails to hold and drops back toward $70, then we're in for more of this choppy, volatile action. Second, watch the gold to silver ratio. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. When the ratio is high, silver is cheap relative to gold. When the ratio is low, silver is expensive relative to gold. Right now, silver has been outperforming gold, which suggests the ratio is falling. If that continues, it's a sign that risk appetite is returning to the market and that traders are betting on the more volatile metal. Third, watch the ETF flows very closely. The record inflows into silver ETFs in January were a major driver of the rally. If those inflows continue, there's fuel for higher prices. If investors start pulling money out, that fuel disappears quickly. ETF flows are like a real-time sentiment indicator. They tell you what retail investors are actually doing with their money, not just what they're saying. Fourth, watch the Federal Reserve. The worst nomination triggered this sell-off. Any further news about Fed policy, interest rate expectations, or monetary accommodation will move precious metals immediately. The metals market is basically betting that eventually central banks will be forced to ease policy again. Every piece of evidence that supports or contradicts that bet will show up directly in the price. Fifth, watch physical premiums. During the crash, physical silver in certain markets was trading way above the paper price in other markets. That divergence is important. It tells you that physical demand remained strong even while paper prices collapsed. If physical premiums stay elevated, it suggests that the paper market is not accurately reflecting true supply and demand for actual metal. Let me give you some broader context because I think it helps to zoom out and see the bigger picture here. We are living through an extraordinary period in financial history. Debt levels globally are at all-time highs. Central banks have printed more money in the last few years than in all the previous decades combined. Interest rates are elevated right now, but governments cannot afford to keep them high for extended periods because their interest expenses are eating up ever larger portions of their budgets. Something has to give eventually. Either debt gets paid down, which seems extremely unlikely given current political realities, or debt gets inflated away, which is historically the path of least resistance for governments. Or debt gets defaulted on, which would crash the entire system. If you believe that the most likely path forward is inflation, then gold and silver make perfect sense as a hedge. They're assets that cannot be printed. They're assets that have survived every single currency crisis in human history. They're assets that tend to rise when trust in paper money falls. That's the thesis in its simplest form. It's not complicated, but it requires patience and it requires the ability to hold through volatility exactly like what we just witnessed. Now I want to talk directly to two specific groups of people watching this right now. If you've been holding gold and silver through all of this craziness, congratulations. You've survived a test that many other people failed. You didn't panic, you didn't sell at the bottom, you held your conviction even when the market was screaming at you to give up. That takes real discipline. That takes genuine belief. And if this thesis plays out the way many of us think it might, you'll be rewarded for that discipline. If you've been on the sidelines watching all of this unfold and you're wondering whether to get involved, here's my honest take. This is not a market for casual observers. This is not a market for people who want steady, predictable returns with no drama. This is a market for people who have a clear thesis about the monetary system and are willing to bet on that thesis through thick and thin. Let me give you some broader context because I think it helps to zoom out and see the bigger picture here. We are living through an extraordinary period in financial history. Debt levels globally are at all-time highs. Central banks have printed more money in the last few years than in all the previous decades combined. Interest rates are elevated right now, but governments cannot afford to keep them high for extended periods because their interest expenses are eating up ever larger portions of their budgets. Something has to give eventually. Either debt gets paid down, which seems extremely unlikely given current political realities, or debt gets inflated away, which is historically the path of least resistance for governments, or debt gets defaulted on, which would crash the entire system. If you believe that the most likely path forward is inflation, then gold and silver make perfect sense as a hedge. They're assets that cannot be printed. They're assets that have survived every single currency crisis in human history. They're assets that tend to rise when trust in paper money falls. That's the thesis in its simplest form. It's not complicated, but it requires patience and it requires the ability to hold through volatility exactly like what we just witnessed. Now, I want to talk directly to two specific groups of people watching this right now. If you've been holding gold and silver through all of this craziness, congratulations. You've survived a test that many other people failed. You didn't panic, you didn't sell at the bottom, you held your conviction even when the market was screaming at you to give up. That takes real discipline. That takes genuine belief. And if this thesis plays out the way many of us think it might, you'll be rewarded for that discipline. If you've been on the sidelines watching all of this unfold and you're wondering whether to get involved, here's my honest take. This is not a market for casual observers. This is not a market for people who want steady, predictable returns with no drama. This is a market for people who have a clear thesis about the monetary system and are willing to bet on that thesis through thick and thin. If that sounds like you, then the recent pullback might represent a genuine opportunity. Prices are lower than they were a few weeks ago. The panic sellers have been flushed out of their positions. And if the thesis is correct, prices are going significantly higher from these levels. But if volatility makes you genuinely uncomfortable, if a 9% daily swing in either direction would keep you up at night, then this might not be the right market for you. And there's absolutely no shame in acknowledging that. Different investors have different risk tolerances and different temperaments. The important thing is to know yourself honestly and to invest accordingly. The people who do best in precious metals over the long term are not the ones who try to time every single swing. They're the ones who build a position over time, hold through volatility, and maintain a long-term perspective. They understand that a 30% crash followed by a 9% bounce is just noise in the context of a multi-year move. If you're thinking about precious metals as a short-term trade, you're going to get chopped up by volatility. If you're thinking long-term, the day-to-day swings matter much less. The market just taught an expensive lesson. Those who panicked and sold at the bottom are now watching prices recover. Those who held through the storm are breathing easier. The volatility we're seeing is the market's way of separating true believers from casual participants. Central banks are still accumulating gold. Industrial demand for silver continues growing. And the debt problems supporting the precious metals thesis haven't gone away. They've only gotten larger. What we witnessed was not the end of the story. It was another chapter in an ongoing narrative about monetary trust and the search for assets that can't be devalued by printing presses. The 9% bounce in silver and 4% jump in gold tell us buyers are still waiting for opportunities at lower prices. The underlying thesis remains intact. That's what matters most for long-term holders. Short-term moves will always be unpredictable. Long-term trends build and protect wealth. Stay informed, stay disciplined, and stay true to your plan. Thanks for watching Element Axis. Subscribe so you don't miss the next update when these markets make their next big move.